I often meet people who come to me after multiple retakes in SBR. Whether they had self-study or some lectures, quite often they're just not explained how a certain standard is going to be tested. And of course, I understand that their residual knowledge is going to be quite limited. But when it comes to IFRS 13, fair value measurement, it's close to zero, even though the standard is tested quite often. Now, the first thing that is tested quite often is the definition. The fair value is the price that would be received or paid to sell an asset or transfer a liability in an orderly transaction between market participants and the measurement date. And there are three logical arguments that we need to challenge. So you basically are going to copy-paste this sentence from the scenario and you are going to explain whether the transaction is orderly or not. So for example, if our company sells an item of property, plant, equipment to a major customer, it may be that it is not an orderly transaction if we have some connection, some unfinished business. So maybe this very price won't be the fair value. Market participants means that it's not related party. So not an associate, not a subsidiary, not, let's say, the CFO of a company. Those prices can't serve as the basis of fair value. And the measurement date means that the fair value is measured at this exact date, not half a year before, not half a year after. And it is important to understand that we are going to look at the highest and best use. So, for example, if a company has a plot of land that it uses for agricultural purposes, but if it is converted into, let's say, business premises, then the company could have sold it for much more money, then this business premises use is going to be the major one. And quite often this will be mentioned quite subtle. So you will be mentioned that, well, many other companies have converted their agricultural premises into the business premises. So we would say if they have done that probably this is the best use. So that would be the basis for fair value calculation, despite the fact that we may not yet have the provision, despite the fact that we may have no intention to use it for business purposes. And of course, when calculating the fair value, we will have to deduct all of the conversion costs. So, of course, if, let's say, a market participant can buy this plot of land at, let's say, 25 million, and our plot of land will require cleaning up, that will take 1 million, then they're going to say, we are not stupid, we are not going to pay over 24 million for that. So that would be included. That is slightly different from IAS 36 impairment of asset requirements. In there, when we calculate the value in use, we take the current condition. So we wouldn't take any improvements that we would make. With the fair value calculation, we kind of like deduct the cost of these improvements from the fair value. Not so often. Sometimes you are going to be tested on principal market versus most advantageous market. Normally we use the principal market where the majority of the transactions are going to take place, and the fair value would be the price in that very market minus transportation costs. Not transactions. Transactions relate to the transaction. Fair value is about the value of this asset or liability. So we're going to take into account transportation cost. And finally, the thing that is ignored by the majority of students but is tested quite frequently is the 3 levels of inputs. So for example, if a company wants to fair value shares and it knows that the shares have a market price of that much, but the management has calculated the future cash flows and they think that the fair value should be based on that, you are going to say no. Level 1 inputs, which is quoted price in an active market for identical assets or liabilities, are preferred over level 3 inputs, where is unobservable inputs. So no, it doesn't really matter what management has calculated. If you have a market price in an active market for identical assets, use that. Or, for example, we need to fair value the building and we know that there are similar buildings of similar size, similar condition, similar location, and they have market prices like that. We should base our fair value on that and not on management calculations, because that would be observable inputs for similar, not identical, similar assets or liabilities, and that is level 2 inputs, and this is preferred over level 3 inputs. So that is how it works, and that is how IFRS 13, which is tested quite regularly, is tested.